What's going on, wealth builders? My name is Charles Newton with Secure Harbor Financial. In this episode, we're going to talk about how the infinite banking concept absolutely amplifies house flipping. And we're going to break down the numbers and show you the philosophy and the numbers to really tie the two concepts together so it makes sense to you. Because there's a lot of people that say it's great, but they don't actually show you why or how. So here we go. Let's just break down the deal. One of my friends just flipped a house. He did a great job. He was super successful. And what I want to do is show you guys how, if you were to implement the infinite banking concept within the house flipping process, how it works and why it's so much of a better strategy. So in this example, he purchased the house for $500,000. He used a hard money loan, and that hard money loan cost $4,000 a month. Just so you guys know, it took about 5 months to complete this deal. A few issues with permitting and dealing with the city, and as you guys may know, it's just a huge pain in the ass. So the total cost for the hard money loan was about $20,000. Now the total rehab cost was $150K. So in this example, what we're going to do is we're going to use the whole life policy loan, and we're going to include the hard money loan cost and the rehab cost for a grand total of $170,000. And that $170,000 has a 5% interest expense. Now, they did a great job. My buddy, he crushed it. He sold the house for $830. We're going to show what the total profit looks like. We used a $170,000 whole life policy loan, and this includes the rehab and hard money costs. Now, the cost of the loan itself over the course of these 5 months at a 5% interest rate was $3,542. And so that brings us to the total expense of $673,542. And they profited, they sold the house for $830 and they profited $156,458. So you're probably asking yourself, why would I put my money in a whole life policy and not just pay cash? And when you do that, when you use cash directly, you lose the potential interest that money could have earned in the future. You lose its ability to grow compound interest. Now, typically what a person does is most people will put their money in a bank, and it's probably in a savings account earning half of a percent. So almost no money. And then when they pull that money out, that money stops growing, even though it wasn't really growing in the first place. During the time of this filming, some people will say, well, hey, look, I'm getting 5% of my money market right now. And my rebuttal to that is, that's awesome. That's great. That's better than nothing. But what did that look like a year ago, 2 years ago, 5 years ago, 10 years ago? It probably wasn't that great. Okay, so we're going to show you why this strategy beats the socks off of putting your money in a money market account for a variety of reasons. Now, another reason why you don't want to just pay cash is you give up the ability to use your money in multiple ways at the same time. That's why this strategy, one of the reasons why it's just such an amazing way to build wealth. Now, let's dive in and really figure out what it means to have lost opportunity cost. Okay, so if you go out and you spend money, if you take money out and you pay cash for something, you lose the ability for that money to continue to grow uninterrupted compound interest. And when you're using an infinite banking whole life policy properly designed for high cash value, what you're doing is you're giving yourself the ability to multiply the money that you already have in there. I'm going to break down the numbers and show you guys what that actually looks like. Now, when you're using this strategy, you're tax advantaged, you have liquidity, you have flexibility, and you have protection, and you're creating a legacy for your family. So it's an all-inclusive strategy. The way that the growth of these cash value whole life insurance policies work, and more specifically, we want to be utilizing mutually participating whole life insurance policies with over 100 years track record and that haven't missed a dividend payment in over 100 years. These are all very important things. And you also want to make sure that you have a really solid Comdex score so that you know that the future of your money is super stable. And we'll go into that in more detail in a little bit. So here, when we pull out that money, we had initial cash value of $170,000. Now, even though we pulled that money out, we like to use non-direct recognition companies. And what that means is when you pull that money out of your cash value, when the company, the life insurance company gives you the loan, they don't even recognize that they pulled any money out of your cash value account. So the full $170,000 is going to have a dividend return on that money. These policies typically grow at a 3 to 5% interest rate. And there's different factors that go into play on why that occurs, right? Whether it's your rating or the company that you're using, but they have better returns than bank accounts. And there's guarantees, and then there's dividend payments on top of that. And these dividend payments have not been missed for over 100 years. They have received a dividend payment for over 100 years. Super powerful strategy. And so I'm going to break down what that looks like here. So over the course of 5 months, he would have gained $2,833 in interest. Let's just rewind real quick. Remember, when we pulled that money out, we were being charged 5%, and that cost was $3,542. Now, that means that we spent $709 to gain access to $170,000. Okay, that's 0.5%, guys. That's 0.5% interest rate. That's nothing. That's nothing. And I'm going to show you why that's nothing and what that small fee will get you in the future. This is very highly predictable for this to actually occur. So 40 years at a 4% compound interest rate, your cash value will be to that $816,000 over the course of those 40 years. Guys, this strategy is so powerful. You will become so much more financially efficient. You'll have so much more benefits in your life. You will be protecting your downside that much more. You'll have so much ability to create more wealth by utilizing this strategy. It's incredible. So let's break this down even more. Why utilizing a properly designed whole life policy is better is because when you put your money in a whole life policy, it grows tax advantaged, and in a couple different ways. So there's this thing called FIFO, first in, first out. What that means is the money that you put into, like the basis of the policy, let's say that over the course of the time that you invest into your policy, you put $300,000 into it. You would take out that $300,000 first, and then after that, you would be taxed. But what I like to tell my clients is say, hey, look, when you get to your basis, when you expend your basis, start taking loans on anything beyond that, and then you won't be taxed because you don't get taxed on a loan. Now, you'll have, by utilizing the strategy, you'll have a death benefit for loved ones. But wait a minute, if I take a loan out, will I still have a death benefit? Yes, you will still have a death benefit. All they're going to do is they're going to subtract how much outstanding loan you have, and the rest of the death benefit is going to go to your family. You don't have to worry about that loan anymore. Your family doesn't have to worry about that loan. It's free and clear. And they still get a death benefit on top of that. It's amazing. Now, you also have all the living benefits. A lot of people think of life insurance as when you die, the money gets paid out. But the thing is, you have benefits for chronic, critical, and terminal illness. So when these things, a lot of people think that an emergency is when they lose their job. I would say an emergency is more so if you were to get cancer or have a massive heart attack or have a stroke or suffer some kind of illness or accident at work and you were disabled and you didn't have access to money, right? Or you're on your deathbed. And with these policies, you have the ability to accelerate the death benefit. You have access to that capital to utilize how you want. This is amazing strategy. And on top of that, you have the liquidity, meaning, if you need access to money, you reach out to the insurance company and you say, hey, I want this amount for a loan. And what they do is in a few days, they send it to your bank account. Boom, you have money in your account. And then you have flexibility. Let's say that you have an outstanding loan, but you can't make a payment one month because you have a cash flow crunch. Well, guess what, guys? You don't have to pay that. I would recommend you pay that if you can, but you don't have to pay that. As long as you have enough cash value to shoulder, the interest that it's going to accumulate over time, then you don't have to pay it back. But like I said, I would recommend you treat it as if it was a bank loan and always make monthly payments. And then on top of all of that, most states have 100% creditor protection with the cash value within the policy. So if you're to get sued, if you're to file bankruptcy, a lot of states would say, hey, you don't have access to that money, so it's protected. So you could be filing bankruptcy and have $1 million in a cash value life insurance policy, and they couldn't even touch you. And then beyond all of these things, like right now, during the filming of this video, there's a lot of talk about banks failing or just the uncertainty, banks being insolvent. And a lot of people might be a little weary of putting their money in, the banking system. Well, people will argue, yeah, but it has FDIC. But as if you like do any digging, you'll see that the FDIC is so underfunded, it's not even funny. So I am comfortable putting my money in a whole life insurance policy because these companies, their whole job is to mitigate risk. Okay? So when I'm putting my money into the whole life policy and I'm contractually protected and that money's protected, the company's whole job is to mitigate risk and not fail. The whole job of the company and why these companies are so successful is because of the way they're designed, because of their outlook on how they treat your money. So it's an extremely safe place to put your money. If you look at all the thousands of banks that have failed in the past, and you look at, try and find a whole life company that's failed. Like it doesn't happen, guys. It's because of the outlook. It's because of the strength of these companies. So that's why when I put my money there, I sleep good at night. I'm not worried about that money disappearing someday. So look at, guys, I know I covered a lot of information. This was maybe a little technical for you. I would encourage you to watch this video a few times to really let it sink in. But look, if you have any questions, just feel free to reach out to me and I'll be happy to help you guys out, answer any questions, any clarification. But if you found value in this, be sure to give it a like, subscribe, and hit the bell for future videos. It really just helps the channel out, and I'm really passionate about spreading how this strategy works and why it's so darn important. But I really appreciate you watching to this point, and I'll catch you guys next time.